Good morning. This is Dylan Jovine with Behind the Markets. Happy Tuesday. Today, I just want to respond to a bunch of emails and questions I got from a lot of our viewers who are asking me if I believe inflation is going to be such a problem, where do you put your money? And again, it's against the law for me to give any personalized financial advice. I could talk about it in a general way, and I could talk about what I'm doing with my own money. I talk about it pretty regularly. But ever since our government went bonkers spending money just completely off the rails, both parties, ever since they went off the rails, what I've been doing is taking my money and putting it in two things. One is short-term US Treasury money market mutual funds. Short-term US Treasury money market mutual funds. I use Schwab, but you can get them anywhere. Vanguard, short-term US Treasury money market mutual funds. They only invest in short-term US-backed instruments. 30 days, 90 days, T-bills basically. Under a year is my sweet spot. And the reason we want to avoid long-term treasuries is, think about it this way. We know the government is running budget deficits out of control. There is no more conservative party when it comes to fiscal restraint anymore. That's gone. It just doesn't exist. So we know they're spending their way into bankruptcy. And a bankruptcy of a country like ours doesn't look like you might think it does. What happens is the value of the currency just gets degraded. And so you need to own assets. So a big chunk of my money goes into short-term treasuries because those are more sensitive to get adjusted. The yield on those get adjusted. I avoid long-term, anything long-term. I don't go out personally after beyond a couple, 3 years. Because think about it this way. We know the government's running us into a bankruptcy, basically. And how do governments go bankrupt? They just end up printing more money. Hard assets are better to own than long-term treasuries. Imagine you own a house that you rent out. So long-term treasuries are paying 5%. You lend the government $1 million, you get 5% a year for the next 30 years, okay? Now, that's still $50,000 a year no matter what. That sounds great. But if you put $1 million into a hard asset like a house, what you can do is, as inflation comes up, you can raise your rent from $50,000 a year to $60,000 a year to $70,000 a year. So you want to invest in hard assets, not fixed long-term assets like treasury bonds from the US government. Because again, you're going to get that fixed payment of $50,000 a year no matter what a dollar is worth, no matter what kind of inflation thing happens. Whereas if you own a house, you basically are able to charge $50,000, you get inflation, make it 55, 60, 70. By the end of 30 years, you're charging $80,000 a year for that house to rent it. Whereas if you put $1 million in a 30-year bond, you're still getting that same $50,000 a year. So you lose money. So I suggest owning things that have pricing power, that can raise their prices above the inflation rate. That includes houses, real estate. This is why so much money's gone into real estate, so they can rent these things out, hard assets like that. But my personal preference is the stock market. I actually am not a big real estate guy. I find them to be cumbersome transactions. You got to negotiate it. You got to do this. You got to sit down. You got to write a deal. Then they try to change the terms. Then you got to check this. I prefer the stock market because I could buy any company that trades within 3 minutes, in and out, boom, buy or sell, and I don't have to worry about all that nonsense. But I know a lot of people make a lot of money with real estate. But for me, it's the stock market. And the reason I love the stock market, it is like owning a house where you could raise your prices with inflation. Basically, companies in the real world are able to pass the cost of inflationary increases on to customers. Now, there are two types of companies in the world, basically. Companies that can just pass basically the cost to customers. And then there are special companies that can actually raise their prices above the inflation rate. And these are companies like Hershey's, where they can see 3% inflation, raise their price 5%, and you're still going to go buy that Hershey chocolate bar. I know I am. So they actually boost their profits. So there are certain companies that have pricing power. All the brands that you know, Coca-Cola, Starbucks, all these companies have super pricing power. Also, inflation is good for actually merchant processors because they do bigger value dollar transactions. There's a whole bunch of things that happen during inflation, but the last place I would put my money is if I had $1 million in a 30-year treasury that pays 5%, because again, I'd get that $50,000 a year. Compare that to a hard asset like owning a house and putting that $1 million there. You could raise that rent from $50 to $60 to $70 to $80,000 a year to $100,000 a year, whatever. And of course, in the stock market, the companies that you buy, they do that. Just consider that. Consider that as you think about what to do with any excess funds. The worst place, the absolute worst place, is to just keep it in a savings account doing nothing, because those things don't really pay anymore. The second worst place, in my humble opinion, is in long-term treasuries. Anyway, that's all I have today. Have a happy Tuesday. I will see you tomorrow.